What if I told you there's a price imbalance on your chart that you can identify with almost zero subjectivity? That's the fair value gap, or FVG. And in ICT framework, the FVG is one of the most useful premium and discount arrays because it's right there on your chart. You don't have any guesswork to see where it is. A fair value gap is created by a 3-candle price delivery where there's an imbalance between the first and the third candle. So for a bullish imbalance, the low of the third candle is above the high of the first candle. So for this example, we can see 1 candle, 2 candles, 3 candles, and there's an imbalance. That is a bullish fair value gap. And for a bearish fair value gap, we have, for this example, we have 1 candle, 2 candles, 3 candles. And the high of the third candle does not touch the low of the first candle, leaving the middle candle. That's your bearish fair value gap. So basically the space between the candles, that represents an area where price moved too aggressively and did not allow to trade efficiently. And that's what makes the FVG so interesting. When price moves away from a fair value gap, we often want to see whether price will eventually rebalance that efficiency. So when price trades back into the fair value gap, we need to pay close attention. And that's where things get even more interesting. You see, the midpoint of the fair value gap, or consequent encroachment, that's the 50% midpoint. Think of it as the equilibrium point of the imbalance. So if we look at this large bullish imbalance, the midpoint, that is what we class as consequent encroachment. Now imagine price retraces into a bullish fair value gap. Price trades into the gap but cannot close below the consequent encroachment. Why is that important? Because despite the retracement, price is still being rejected from trading deeper into the imbalance. The market is showing us that the FVG is being respected as a PD array. And when that happens, in the right market context, especially with liquidity, displacement, and market structure supporting the direction of the fair value gap, that can become a very powerful area for an entry. But remember, not every fair value gap is a trade. A fair value gap tells you where you may have an opportunity. Your higher time frame bias, liquidity, displacement, market structure, and timing will tell you whether you should actually take a trade. That's why I love fair value gaps. They're objective, they're easy to identify, and when price returns to them, the way price behaves around the consequent encroachment can give you valuable information about whether that imbalance is being respected. That's why fair value gaps are so powerful. Follow TriniFX for more ICT concepts from my perspective. I'll see you in the next one.